Okay, let's dive into this explainer and master an essential, highly tested topic for the CFA Level 1 exam, equity index construction. I am seriously thrilled to walk you through this today. Because look, this concept from the equity module isn't just dry theory. It's incredibly practical, it drives literally trillions of dollars in the real world, and most importantly for you right now, it's heavily tested by the CFA Institute, often through some pretty tricky numerical questions. Here's our roadmap for today. We're going to cover what an index actually is, break down the 4 weighting methods, tackle rebalancing versus reconstitution, run through some exam-level practice questions, and finally, wrap up with my pro tips for CFA success. All right, Section 1. What exactly is an index?
Well, an index is essentially a hypothetical portfolio of securities representing a specific market, sector, or investment strategy. Think of it as your benchmark measuring stick for performance. Now, you already hear about famous examples every single day on the financial news, right? The Sensex and Nifty 50 in India, or the S&P 500 in the US. But today, we aren't just looking at what they are. As future charter holders, we care about the hidden engineering behind the scenes. How are they actually built?
That brings us to Section 2, the 4 weighting methods. Let's break down the core mechanics you absolutely must remember for exam day.
First up is the price-weighted index. In this method, stocks are weighted strictly based on their price per share. The formula is literally just the sum of all the stock prices divided by a specific divisor. Now, what's kind of wild about this method is that the actual fundamental size of the underlying company doesn't matter at all. A higher share price simply equals a higher weight in the index, period.
Imagine this scenario for a second. Stock A trades at 100 rupees and stock B trades at 50 rupees. Under this method, stock A gets exactly double the weight of stock B, even if stock B is a massively larger company in reality. And this brilliantly highlights the glaring problem here. Think about it. If a stock undergoes a stock split, say a 2-for-1 split, its price drops by half. Suddenly, its weight in the index drops by half too, and the entire index gets completely distorted unless someone manually steps in to adjust the divisor.
Next is the market capitalization weighted index. Spoiler alert, the CFA Institute absolutely loves to test this one, mainly because it's the most common method used in the real world. Here, a stock's weight is its individual market cap divided by the total market cap of the entire index, so it actually reflects the aggregate market value, meaning larger companies naturally wield far more influence.
So, the absolutely crucial takeaway here is that unlike the price method, a massive company with a cheap stock price will still completely dominate the index over a tiny company with an expensive stock price. Just look at the numbers. Company A has a 10,000 crore market cap, while Company B is at 5,000 crores. Regardless of what their individual share prices are doing, Company A gets precisely 2 times the weight of Company B. Size is what matters here.
Our third method is the equal weighted index. This is the great equalizer. In this approach, every single stock gets the exact same importance, completely regardless of its size or its share price. Small companies get the exact same weight as the massive giants. So if you have a simple index with just 3 stocks, they each sit at precisely 33.33% of the portfolio.
Now, that sounds incredibly fair and simple, right? But watch out for a massive conceptual trap they love testing you on. Because stock prices constantly change every single minute of the trading day, those equal proportions get skewed almost immediately. Because of this, equal-weighted indices require incredibly frequent, tedious, and costly rebalancing to stay perfectly equal. Your broker's going to love the transaction fees, but your portfolio return definitely won't.
Finally, we have the fundamental weighted index. Here, the weight is based on fundamental financial factors, things like a company's revenue, its earnings, or its book value, rather than relying on arbitrary share prices or inflated market capitalizations. This is a much more value-based approach. It attempts to dodge market bubbles by looking at the actual financial health of the business rather than just blindly following market sentiment.
Moving right along to Section 3, rebalancing versus reconstitution.
These are 2 critical terms that students constantly mix up on exam day. Rebalancing is really just tweaking the internal weights periodically. For example, if a company in an equal-weighted index grows way too fast, its weight increases and you have to trim it back down to baseline. Reconstitution, on the other hand, is a completely different ballgame. This is entirely kicking a stock out of the index club and inviting a new one in to replace it. Think of it like this. Rebalancing is adjusting the dials. Reconstitution is replacing the players.
Section 4, Exam Level Practice.
It is time to test your knowledge, where the rubber meets the road with some tricky CFA-style numerical questions.
Let's look at this first one. A price-weighted index has 3 stocks priced at 20, 30, and 50 rupees. What is the index value, assuming we are ignoring any complex divisor adjustments for now? Pause for a second. Think about the formula we just covered for price-weighted indices.
All right, let's break down the math. Step 1, you simply find the aggregate price. 20 plus 30 plus 50 gives us a sum of 100. Step 2, you divide that sum by our base divisor. In this super simple case, that's just the number of stocks, which is 3. 100 divided by 3 gives you an index value of 33.33. Simple and straight to the point.
Now let's level up a bit. In a market cap weighted index, stock A is priced at 100 rupees with 1,000 shares outstanding. Stock B is priced at 50 rupees with 2,000 shares outstanding. So, which one has the higher weight in the index? This is a classic exam trap designed entirely to see if you get distracted by the individual share price.
Let's do the math. For stock A, 100 rupees times 1,000 shares equals a market cap of 100,000. For stock B, 50 rupees times 2,000 shares also equals a market cap of 100,000. Because both market caps equal exactly 100,000, they carry the exact same weight in the index. It completely neutralizes the difference in their share price. When you're sitting for the exam, do not let that 100 rupee versus 50 rupee price tag fool you.
Okay, here is a highly conceptual question they really love to ask. A stock in a price-weighted index undergoes a 2-for-1 stock split. What happens to the index? Now, what happens conceptually when a stock artificially halves its price overnight without the underlying company actually losing a single dime of real value?
Well, if you don't do anything, the index plummets. Because the price drops by half, the formula's numerator shrinks. Therefore, the divisor absolutely must be adjusted manually downwards. If you don't do that, the overall index value will falsely signal a massive market crash that literally didn't even happen. You always have to balance the equation. Finally, Section 5, Pro Tips for CFA Success. Let's wrap this session up with my insider secrets to ensure you squeeze every possible point out of this module. First, focus heavily on why these methods exist, not just memorizing the math. Second, practice 10 numericals daily to build up your calculation speed. Third, and this is absolutely critical, CFA examiners love to hide stock splits or mix up share counts to trick you. Always read the fine print. And fourth, use the elimination strategy in your multiple choice questions to immediately cross out logically flawed answers. It's going to save you precious time.
You really want to lock this summary matrix into your memory. It brilliantly illustrates exactly how each method is driven and the specific vulnerabilities are going to test you on. Price weighting risks misleading weights based on arbitrary stock values. Market cap naturally overweights mega firms. Equal weighting eats up your capital with high turnover costs. And fundamental weighting introduces immense data complexity. Look, index construction might seem pretty straightforward initially, but precision and concept clarity are literally everything here. By mastering how these benchmarks are built, you've just secured 2 to 4 crucial marks with high accuracy for your Level 1 exam. So the question I want to leave you with today is this. Now that you know exactly how the benchmark is built, are you ready to take this knowledge and uncover the true intrinsic worth of the individual companies inside it? That brings us right to the doorstep of equity valuation models, which we're going to tackle next. Keep practicing and stay focused.